Most traders think the market moves randomly. It does not. Every candle on your screen is a digital footprint of human emotion reacting to information. We call this price action, but it is actually behavioral action. When new data enters the market, humans react. That reaction creates the patterns we see every day. If you understand the human behavior behind the move, you stop seeing lines and start seeing the logic. Strip away the indicators and the market only has two modes. First, the impulse. This is a fast, powerful move where institutional money enters the market with conviction. It represents a shift in value. Second, the correction. This is where the market digests that move. Traders are taking profits or waiting for more news. Remember this. Every technical pattern you have ever learned, flags, triangles, wedges, is just a different version of a correction. The pattern is just the market catching its breath before the next decision. This type of behavior, these two modes, the impulse and correction, goes back to the beginning of charts. We are here on Euro US dollar on the weekly chart. So keep in mind, the euro was introduced in 1999, respectively in 2002. So what we are looking here is actually the Deutsche Mark. And we can see we are clearly here in an impulsive move to the upside. So we have here an impulsive move, then we are here in a correction, and we leave the correction again in an impulsive move. And the same behavior you can find within the correction as well. Let's see how we entered the correction here on a smaller degree. We have an impulsive move into a corrective phase, into an impulse. And then again, from the high, we have an impulsive move into a correction, into an impulsive move. And then here again, we are basically breaking out of this pattern again with an impulsive move into a correction, into the next impulsive move. And of course, this behavior happens on all the time frames. Let's move on to a more recent example. We are still on Euro US dollar on the weekly time frame, and we are here in COVID times. So we had here a very long corrective phase, and we then broke out of this corrective phase in form of an impulse into a correction, into an impulse. And after this impulse correction impulse, you would expect here a larger continuation pattern. And that's something you would then forecast like this. And you would overall look for a larger continuation pattern. You would look for this impulse correction and the next impulsive phase. But then during these times here, when we are waiting for price action confirmation for the continuation to the upside, the US released better than expected data in July 2021. And this improved economic outlook for the US made this next move here more unlikely. And what actually happened, this continuation pattern failed, and we broke out impulsively of this larger corrective phase. We also did tap into this area of interest here to the left. So basically the fundamentals, they provide the why. Think of it as fuel for a car. The technical setup is the vehicle, but the fundamentals are the fuel that make it go. We had this impulsive move into this area of interest here to the left, and you would expect some form of reaction. You would either expect a continuation to the downside, or you would expect some reversal from this level. And what we got was in February 2022, Russia invades the Ukraine. And then, of course, after this impulse, this corrective phase will most likely become a continuation pattern for a further sell-off in the euro against the US dollar. And indeed, this event was the start of a 16, almost 17% sell-off in the euro against the US dollar in a fairly aggressive, impulsive move. Price does two things. It continues a trend or it reverses it. The left picture shows a trend continuation. We have an impulse leading into a correction and a same way impulse. The right picture shows a trend reversal. We have an impulse, again leading into a correction, and an opposite impulse. And here is how we trade. We don't try to guess the exact top or bottom. Instead, we identify the market phase we are in and align it with our overall fundamental bias. From there, we forecast. We forecast the potential price pattern. We define a clear set of if-then rules for that specific setup. We aren't trying to be right about where the market goes. We are waiting for the market to prove our forecast. If price hits our zone and fulfills our rules, then we execute. We don't jump in a trade anticipating a move. We wait for confirmation and trade reactionary. So let's have a look here at this impulsive move after Russia started the invasion in Ukraine. So we have the overall bearish sentiment here, and we are still on the weekly time frame. And you can see here, just with natural progression, you would expect after this impulse a correction, an impulse, you would expect more correction and further impulses until we get another large fundamental change in sentiment. I'm going here first to the daily. And here on the daily, we can already see this initially messy price action starts to look fairly clear. We have here, after this impulse, another 3-touch continuation structure. And if you are a daily time frame trader, that's already a fairly good entry. But you can see here with the stop loss, you are here at around 160, 170 pips. So let's see if we can refine that even a bit more and go down to the 4-hour time frame. And here on the 4-hour time frame, we can refine our entries even more. We see we have some areas of interest here. This is the start of this last leg to the downside. We then have a 1, a 2, and a 3-touch bear flag continuation structure. And in terms of price action confirmation, we can enter here after this second bearish reversal candle and be even a bit more aggressive with our stop loss. And then you can see initially we had 180 stop loss on the daily, and by using the multi-time frame approach, we are now down to 80 pips on the 4-hour time frame. So that's a nice example to show how the fundamentals, they dictate our overall bias, and then we use the multi-time frame approach to drill down to the lower time frame to refine our entries. Price moves because humans react to events. We look for the impulse to see where the big money is going. We wait for the correction to find our lower risk entries. We use fundamentals to confirm our bias. That is basically how price patterns emerge. And we stay disciplined for price action confirmation. If the setup isn't simple, it isn't there. In the next video, we will talk about the roadmap that stops you from second guessing these moves. The forecasting process.